Hi, I'm Dan with Pay Down Debt Solutions. Welcome to our channel. Today we're going to look at, let's say it was a potential client. She's a student of Velocity Banking, but she's also a practitioner. Just call her S for short. What you don't see, because I didn't have to write it down, was the 6 credit cards she already paid off herself using Velocity Banking, using her personal line of credit. You can see Navy credit card, so she banks with Navy Federal. She got it to this point, paying off those 6 credit cards. She kind of got stuck. She said, it's like, I'm just not getting it down. So like, yeah, the interest is low because, moving money, putting a big portion of her check on her line of credit and putting her expenses on it. And she just kind of ran into a bit of a slump. So she contacted us. Now, everyone knows the saying, like some people you just can't help. It's not a question you can't help. She really didn't need help. I just emailed her yesterday. I'm like, we don't need this coaching call, because I literally said, and I hate saying literally, but I put it in the email in one sentence, comma, and I laid the steps out for either or, whether she uses these 2 tools or Jen was talking to her about, because she went to Navy Federal for her personal line credit. She said they wouldn't approve anything over, I didn't write it down here, but this has got $3,000 limit. And that makes it tough splitting bills, splitting payments, splitting your checkup, tracking everything, especially if you have, let's say, a regular living expense and you're charging it, but then you have an unexpected expense that month. Now you have to calculate and recalculate everything. Well, hey, I bought a $200 dress for that wedding. We decided to take a little vacation. It was $500. Save for a hotel for 2 nights and some gas. So then you get to calculate, well, now how much additional do I got to put on it? And do I take it away from the other thing, like the line of credit for the credit card or vice versa? It's not a mess. You can do it, but it makes it unnecessarily complicated. So let's look at how I set everything up. So you can see her total expenses, $4,002 versus her $4,449 income. Breaks down to chargeable expenses at $1,240, non-chargeable expenses at $2,762. Her available income is the total income minus non-chargeable expenses, $1,687. So just off the bat, I just wanted to see, all right, let's pay down. Let's use the credit card as the debt destroyer. Right, so her available income, $1,687. That's going to increase by 150. And that increases by 150 because by putting additional money on the credit card, that payment gets satisfied. Right? So that becomes more available income. Right? So that's 1,837. Right? Chargeable expenses stay the same. Those aren't going anywhere. 1,240. So I won't show you the math in these steps. I'm just going to give you the broad strokes on using the option with these 2 debt tools, and then I'll get into what she's doing right now. Well, it's Saturday, but she is in the process of doing, and that's seeing if she can find a personal line of credit, because she has good credit. She's 680, so she should qualify for more than the $3,000, especially with her debt to income. When she gets into it, I don't know what her gross income is, but she should qualify based on the numbers you don't see here, all the numbers she sent to us. So when you plug these in, excuse me, you'd get 12 months and $758 in interest, right? And what we're doing is we're using that Navy Federal credit card as her debt destroyer. So she's putting all her available income, which is the income after she withholds money for non-chargeable expenses, mortgage, other bills that can't be paid, like a car loan. They can't be paid directly cannot be paid from a credit card. They'd be paid from a checking account. So we put that on there. We add that payment back in because that payment's satisfied each month. We put the available income on. So it's $1,837, chargeable expenses. Spare you the calculations, 12 months, $758 in interest. I use that as a baseline just for an idea. I'm like, all right, that's just if we do that. But in the same time, that 12 months, this has only been paid down $360. So she'd do that, and then she'd have the PLOC, and then she'd have to split things up again. Well, how much should I put on that? How much should I not put on that? because her expenses are higher than the limit on her line of credit. So I did a hybrid. And in the hybrid, I had to play with the numbers a bit. Don't think like, oh, I just knew what to do or how much money. I tweaked the numbers back, did a high, a low, and I kept splitting them by 50 to half. So if I thought, well, I'll move 100, like, well, that's too much. Well, I tried 50, that was too little. And I tried 75. I'm like, well, they're closer. So then from 75 to the 100 was too much. 75 was the new minimum. I split it again. Instead, I just added. I was going to start adding 5, so I don't know how to do it like 5 more times. So what I came up with was you pay an extra $80 a month on the Navy personal line of credit. So now you're paying $110 a month on the personal line of credit. So easy peasy. She can do auto pay. Instead of doing 30, you send 110. No bills are going on it. We're doing what's called traditional velocity banking, non-charge, withhold money from your net check every month for non-chargeables. You put the rest of your expenses on your debt destroyer, in her case, the credit card, and you start working it down. You start paying down your debt. So by bumping this up from $30 to $110 per month in 14 months, this will be gone. This will be paid off. Her personal line credit will be paid off with $112 in interest. So, but we altered this. We took $80 away. We go minus 80. That'll equal $17.57. So now these numbers I'll show you. So we plugged in available income, $17.57. Chargeable expenses don't change, $1,240. Remember, this is all happening simultaneously. All she did was bump up her personal line of credit from $30 a month to $110 a month. That took the $80 away from her available income because she has to pay that from her. She can't use a credit card to pay that. So it changed this number, which, because AI, available income, depends on total income and non-chargeables. I did the long way of explaining it. This was the short way, was the math. Chargeable expenses. When you plug that in, you get 14 months. And $895 in interest. So that's how I told you I started at 100. How much to bump this up by. Went to 50, too low, 75. Then I came to 80, so I added 80 to the 30 original she was paying. Got them both paid off in 14 months. Total interest, $1,007. Now remember I said I was going to get to the math on this example, because this is what I came up with her. Then Jen started talking to her, and she's like, okay, I prefer Navy Federal. She's going to look for a personal line of credit that we expect her to qualify for because she's got 680, so she should qualify to get a higher balance. It's a little extra work for her because right now her paycheck is auto-deposited into a checking account at Navy Federal, so this personal line of credit card are all linked. She goes to another bank to eliminate her debt and does should opening a checking account. She then has to go to work. You got to move, where your paycheck's going. It's a hassle, but for her, I think it's worth it. I think she'll get it down. She'll decide for herself. I think it's worth it, but I'm just looking at the cold numbers. I'm not looking at how far she's got to drive to the bank, or if she's working 7 days a week, 12 hours a day, where's she going to find the time? I'm not the human side of it. I'm just looking at the numbers. So here's the one alternative. I kept her checks as easy as possible. All her chargeable expenses are going on the credit card. All she do is bump up her minimum payment to her line of credit. She's withholding her money from her check, non-chargeable expenses in her checking account for those bills. But if she does get that additional line, I shouldn't say addition. Yeah, it is an additional line of credit with a higher balance. Now the total is irrelevant, but we'll keep those numbers up there. And I'll show you. So let's say I picked a random number. Remember I said, as long as the limit on the new line of credit exceeds this $4,002, she uses that debt destroyer. if she's got to chunk it, that's, let's say a video for another day. Excuse me. We're going to pick, say she gets one for $10,000. We'll just pick something high. We'll pick 11% interest. Oops, I don't need a dollar sign. I just need the interest sign. 11% interest. So now she combines these two, right? So she eliminates those payments. She combines these two, and her starting balance on a new line of credit, called new PLOC, on her new line of credit, her initial balance will be $9,332. Her available income becomes her total income, because that line of credit can be used just like a checking account. So what she'll do is she'll take her total income, and as soon as she gets it, she'll deposit, it'll auto deposit to her check. She'll transfer the money to the line of credit, bringing the balance down by $4,449. Based on average daily balance, the way it's calculated, she immediately starts saving on interest. And the difference is how fast it'll pay down. $4,449 versus $4,002. So that's the starting balance. And I will show you the math on this so you guys can do this yourselves. That is the point of all this. Do we offer coaching? Yes, we do. Jen probably has numerous videos on here. You can check the website. That for us is the fallback for you guys. We are trying to put as much information out there for you guys to be comfortable doing all this on your own, hopefully with more examples. If it doesn't just broaden your sense, you'll find the example and be like, that's mine. All I have to do is plug my numbers in and copy what they do on the board, and you'll be able to see your own results. But if we do enough examples, if we got something that doesn't quite fit, you'll be able to figure it out. I know you can. It seems like finance math or accounting math. It's simple arithmetic. The concepts are accounting. The concepts can be a little tough. That's why if we provide as many examples as we can, you don't need to worry about the concepts. You just want to find the pattern that fits what you have. Plug in your own income. Plug in your own total expenses. Split them up by chargeable, non-chargeable. Then look at what you got. And here we prefer using the personal line of credit. Not hugely lower, but a lot of times it is. Most people have like 25% interest on their credit cards. And a personal line of credit's always less than that. I don't even know if they offer anything. I'm sure they do. I shouldn't say that. I'm sure somebody offers a line of credit for 25%. Or, excuse me, a HELOC or a PLOC. But typically you're going to get them around 10, 11. Right now, that's about where they are. Let's say the Fed reserve rate comes down, they'll come down like mortgage rates come down. All the interest rates get better on loans. Anyway, that was a tangent. So let's get back to it. $9,332 starting balance. The available income is her total income. Because she can use that line of credit like a checking account. She's going to put her whole check in. Her check gets auto direct deposited to her bank account. She transfers that into her line of credit. And then as a bill comes due, she just transfers it out to a checking account and then writes the check. You want that money. Part of the key to all this is the money sitting in your line of credit, whether it's a personal line of credit or the credit card is your debt destroyer. The money sitting there is saving you interest. It's sitting in your checking account does nothing for you. You put in there, you're saving on interest. And you're satisfying that payment, which increases your available cash flow every month. So the available income is $4,449. Total expenses. Normally we talk chargeable expenses. All that's out the door. We're using a line of credit. $4,002. Right? So you saw this. You see the 2 here. Just added an extra $80 to the down payment on her existing line of credit. I subtracted that from the available income because this is a credit card, so she can't just use her total income. Chargeable expenses, 14 months, $1,007. Not bad. Can't write today. I said rainy Saturday morning. This is full speed for me for a rainy Saturday morning. So let me erase this. Sorry, $1,007, not 100. There we go, $1,007. Let's take this away. And let's look at the difference. And she might even do this for other things. So I've said before, actually, I think I said in my last video, this gets you out of debt. And most people are like, well, that's it. You're happy. Well, it's better than that, especially if you've got a line of credit. What happens is when you get comfortable and you get everything set up, if you were waiting, hey, we really need a new car. You know, man, wouldn't it be so nice to have a patio out back or a new barbecue or whatever? Jen and I with the kids, I mean, kids always want what kids want, but Jen and I with the kids, we never look for things. We look for what fun we can all have. If there's something we could buy that we could all enjoy, we may not be able to afford it, but we'll at least consider getting it because no one remembers the stuff they have. I don't remember stuff I enjoyed a year ago, let alone 3 weeks ago. I have no idea. But I remember all the crazy stuff me and the kids have pulled. And Jen too. Jen's a partner in crime. Oh yeah, that's the stuff I remember. So that's why if you hear me pick, I'll pick a car. It's a necessity and something you can enjoy too. If you get the car you've been waiting for, patio, the whole family, friends, everything. You'll always hear me picking examples like that. It's not me trying to life coach you. It's just how my brain works. I think of stuff like that. Like, you know, Jen and I get in a pool or something. I'm like, everyone's going to enjoy that. It's going to be a lot of work for me putting it in or prepping for it. A lot of work for Jen maintaining it, but we'll all enjoy it. A lot more fun. Okay, I'm going on tangents. All right, so let's look at these numbers. So we're going to start with the starting balance. Remember, this is her new line of credit, right? This is the balance. She combined these two. We're not looking at the car loan yet. We're going to work on this first. So there's your starting balance. What's she do? She puts her whole income on it. Her net pay, her paycheck. Right? 83. Then she puts her chargeable expenses on. Right? Plus 3,882. Now you'll see that 3,882 doesn't match the 4,002, and that's because these two payments went away. 4,002 minus 180. 3,882, right? And then we're going to have interest the first month, $65. So at the end of the first month, the ending balance, 8,830. Right, now how do we come up with all these numbers? Starting balance, her total income that gets direct deposited to her checking account. She transfers it over to her line of credit. In the month, this is the balance left over, right? The start of the month, you start first day. Let's say the second day your check pays on it. That's your main balance. These are her expenses. And now how do we calculate that interest? We calculate that interest by taking the high balance, which is the starting balance, and the low balance for the month. We add those two together, right? So we add them. Put that in parentheses because we're going to add them. Then we're going to divide by 2. That probably looks like Greek to you. I can put a box around it so it doesn't look so much like an algebra problem from high school that I know I didn't enjoy. Right? So we add them together. We divide by 2. That takes the average. Okay? Then we're going to multiply it. Do another box. We'll extend that. I am so used to doing parentheses and brackets and all the fancy math stuff. I'm fighting myself, right? But then we got to multiply it by the percentage. The percentage. We picked 11%. 11%, simple interest, just calculated based off average daily balance, no compounding. So how do you do the 11%? Take the 11%, divided by 100, right? That equals 0.11. Makes sense, because if you want to know what 11% of 100 is, multiply that 100 by 0.11, and you'll come up with 11. Very simple math. But that's also still for the whole year. You want to know for the month. Month's got different days, there's different billing periods, so we kind of take an average. So you take that and you divide it by 12. So, let me grab that calculator. You can see me turn in circles. I'm surrounded by a semicircle of tables, and I couldn't remember where I said it. So we'll do 0.11 divided by 12. So you get a big fancy number, equals 0.00917. That's your multiplier. You can take the percent of a number, like I said, like 11% of 100, but you can't multiply 11% by 100. You take that 11% divided by 100, that gives you 0.11. Then you can get 11% of any number. Take 0.11, multiply it by anything. Then we got to divide by 12 months, so that's your monthly interest multiplier each month of the year. For a fairly accurate present for what we're doing, the way these numbers work out, because we're all projecting this into the future, it's not based on actual charges you've already made and bills you've already paid. We have to estimate looking forward. That gives you 0.00917. So you're going to take that, that's this percentage. You take that 0.00917 times the average of these two numbers. That's how you get your $65. I can't emphasize this enough, because when you get comfortable doing this, moving your paycheck deposit, moving your monthly bills to this card or that card, that it'll all get easy. Just remember, always stay organized. Write it down on a notebook you won't lose, or it's what I prefer is a notebook too big to lose, like a big heavy one, because it's easier for me to spot. Or a colorful one. That's how Jen does it. And she's got great memory, so she actually remembers which colors go to what. Anyway, right? So each thing you set up, this card, this amount, this account it gets paid out of, or line of credit gets paid out, then keep track of your login, whether it's your personal email and your password. Write it down, because what happens is, especially if you have steps, like say she still had her 6 credit cards, well, you're going to be paying bills on your debt destroyer. You're going to work something down, and then if you work, something, you want to bring something else over, you might not be able to. You might not be able to get that balance transfer. You might have to move your debt destroyer to another credit card to pay down your next highest debt. Excuse me. And you're always going to want to start, almost always, unless you have a line of credit, start with your highest credit card payment. It instantly gives you the higher cash flow, and it pays that higher debt down. Because you guys probably know, interest rates obviously play a role, but typically where your biggest debt is where your highest payment is. Right? Simple. Doesn't require a higher accounting understanding or finance. But let's keep going. So I took you through month 1. You can see how much we paid it down. $500. And what I say it was the difference between this is $447. So let's get rid of my fancy math. So in 1 month, so let's do the second month. Starting balance next month, $8,830. Right? This is on her new line of credit. She's going to put her whole paycheck direct deposit to her checking account. She's going to transfer it over to her personal line of credit, park that money there, keep that interest as low as possible. It's going to make this $4,381. I went through the big long math. I'll just say it this time, spare you the math lesson. This is the high balance for the month, the starting. She put her whole paycheck on it. This is the lowest balance of the month. We add those two together, divide by 2 to take the average. Then we multiply it by the annual percentage divided by 12 for the interest that month, right? But the month, she puts her bills on it, right? All her expenses and bills, because we're going through the line of credit. And that one, the interest is $60. Ending balance, 8323. Now you could just look simply at, well, if the difference is, $447, well, that's how much it gets pays down each month. Like, you could do the easy math. If it's a short calculation, it'll be fairly accurate. But if you got big debts and you're looking at 3 years, of moving money and combining them to pay it all down, you got to do it this way to be accurate. Because the reason velocity banking, I don't remember exactly why he named it that way. I can't remember the definition from the book that started all this. Excuse me, got itchy eye, allergy season. So by parking that money in there, yeah, the numbers are the same. Total income, bills, new balance. Starting balance, total income, new bills. But by parking that money, the interest you're paying decreases every month. It keeps going down. And I'm not going to take you through the rest of these. I think you guys have a big idea, but I'm just going to show you what the interest does. By parking it's not really parking, by moving your total paycheck from where it's deposited, your checking account, and putting it into a line of credit whether it's a personal line of credit or credit card, that's what it does. It's going to lower this each time. Obviously, paying the balance lower also makes it lower, but it accelerates it. The money being in there pays it faster. So what happens is this is going to go 65, 60, 55, 51, 46, 41, 36, 32, 27, 22. Each month you're paying less and less and less interest. By one, lowering your average daily balance, putting your whole check in there, this doesn't come, the expenses don't come in all at once, they come in as they come in. So you're lowering your average daily balance, which is decreasing what you would have paid for the total that's on that card each month because of the way average daily balance is calculated. So let's look at what's the final numbers. I had her using her initial thing we discussed. I had her using her Navy credit card as her debt destroyer. She bumped up the payment on her Navy personal line credit from 30 to 110. Then she kept money out of her paycheck for non-chargeables. She put her available income of $1,687. As soon as she got in her check, she put it on her credit card. Then she used that to pay her chargeable expenses. That combination, both things were paid off in 14 months and $1,007. And this is where I say is, to me, it's worth it because I just look at the hard numbers. She's got to look at how much work it takes, what's it really worth to her. But if she does get a higher balance, and let's say a balance high enough where she can, put the two loans together, $10,000 is very reasonable. 11% on her interest on her new personal line of credit. What we're looking at is 10 months. Let me go back. 10 months, $445 in interest. So she is paying under 50% in interest, and she cut, almost about 30% off? Yeah, give or take, about 30% off in the amount of time. So that much money is nothing to sneeze at, but she's got to look at for herself, because we told her we're doing this video, because after I told her, you just don't need it. You're already a practitioner of velocity banking. Like I said in the very beginning, there's 6 credit cards on here. I didn't even write because she already did velocity banking and paid them down herself. And then she just got kind of muddled at the very end of really just how to split money up and do it. But in one sentence, I told her, do what I said earlier. Increase that by 80. Make this your debt destroyer. Put your chargeables, use your chargeable expenses out of your total. Put the available income, what's left after you withhold your check for your non-chargeables on there. 14 months, $1,007. Both of these are paid off. And this will actually, I should have gotten more into the next step, because the next step is to pay down the car loan. I won't show you that we got plenty of examples of that unless you want to see this example carried out. DM us on our channel and I'll go further. But she saves this, but when she looks at having that bigger balance, she can then chunk the car loan down faster. And what's beautiful is you don't have to do this math over and over and over again. So look at what she's got, $39,200. If she's got $10,000 on here, she only has to do the math once. You can do it more if you want to be hyper accurate, but basically she can take the $10,000, starting balance, right? So she's chunking that car loan down. Boom. She paid off everything else. Let's take $10,000 off that loan. So we'll make that $29,200. We'll keep track of it. What I'm saying is she only has to do the math once. It's a fixed, same starting balance, same percentage. Same income, same expenses. And I don't need this anymore because I can do any of these calculations, right? So starting balance, taking a big chunk out of that loan. The low balance for the month is $5,551. Total expenses, what is it? It's not $4,002 because it's $4,002. That was based on these initial, and she's already paid those off. The loan doesn't go away at all, of course, until it's paid off. So we have to subtract that, but we take that out of there just like we did earlier. $3,882, right? And I'll give you some numbers. So we're going to add these together. And I'll write it out. So you guys can always reference this. 10,000 plus 5,551. That's easy, 15,551. Then we got to divide by 2. Right, so that's our estimated average daily balance. We'll round it up. Right, then we got to multiply that by a percentage. I remember it from earlier. It's the 11% divided by 12 months. That was 0.00917. So I go this amount, the average daily balance we calculated, 0.00917, $71. Right, 71. I'll do this the old-fashioned way. 22, 5, 15, 8, 9, 9,504. Well, what I was getting at was you don't have to do this over and over again. You want to see how much interest, once you get that idea or you pass 10,000, well, 3 times you're going to chunk this down before you get to less than 10,000. So when she carries this all the way out to where she reaches 0 again and adds up each interest payment from each month, she will know how many months it takes to pay off 10,000 with that 11% in her PLOC, and she'll know the total interest by adding up all those interests for those months. And then she can look at, well, I've got this many payments left, I've got this so much interest left, but if I chunk it down, let's say it takes 12 months, I say 12 months, right? I can do 12 months. Then after 12 months, I can do another 10,000, 12 more months. I can do another, so that was like a scribble. 12 months. Well, I got a third one, 12 months, right? And she'll know 12 months, right? Let's say $800 in interest, just picking a random number just so I can fill this in. $800, $800, right? Boom, boom. Then she knows, well, hey, the last one's $9,200, but it's not $9,200. You got to look at how much principal. Go to look at like a loan payoff calculator, like a car loan payoff calculator. You can find calculator.net, Piggly, sites like that online. And you plug in your loan, how much you're paying, your interest. She could do the starting balance. And what you do look at is, okay, in 3 years, 30,000 is paid off. We know it's not 9,200 because in that time, you're still paying this $579 every month. There was no way to roll that in because we couldn't pay the whole car loan off. We're just chunking it down, 10,000 at a time. So when you get that 9,200 won't be it. What you have to look at is, okay, I chunk. What is the remaining payments left? And how much interest is still owed? And that'll be obviously less than this. Then you'll plug that in, you can get the exact number. But understand the math, understand the system. That's not as important. It's important, but is not as important as doing things in the right order. Setting yourself up, starting with the highest payment credit card, or starting with a personal line of credit where you can roll higher interest debts into. When you get that concept down of how to make the selection and move your cards, you'll be living this. If she doesn't want to do the math and she just knows, hey, I know I'm going to pay it faster, do the 10,000, the 11% is good. You're doing the velocity banking, the pay down strategy, putting your income on it, your total expenses on it. When it's low enough where you feel like it, move more money over. You could do it if every few months $1,000 is paid off, you could take $1,000 off of that. Or you could wait however many months it takes. I picked 12 months. Then you could just put another big chunk on it. You don't have to know all the accounting concepts. You just have to know a few key things. The order to pay your debt down that makes the most sense. You'll be able to try. You should try a couple things, and then once you get it down and you figure it out, you can look forward to things in life. Not just being debt free. That's the removal of pain. So we were going to move the pain and all that stress of all your debt using the pay down strategy. That's just the first part. then you can start to look forward to things, because now you can be like, well, hey, that patio, $40,000, like, what was I going to do? Get a $40,000 credit card and all that crazy interest? No, I got this line of credit. That $40,000, if I put $10,000 on it at a time, and I figure out, I do the arithmetic, I figure out that interest for a year. Now I know, well, in 4 years or less, because obviously you're going to be, paying the minimum on that. Assuming, like I said, let's say you took a loan out for your patio, you still have this line of credit, $10,000, so you're going to chunk it down. You'll know, wait, that $40,000 patio is only going to cost us, like, say, $44,000, including the interest. And I'm going to pay it off in, 4 years instead of 10 years on the loan. Or 30 years if you take equity out of your home to then do it. And that would be a home equity loan, which you don't want. You want a home equity line of credit, and you want to do the pay down strategy. Because I end every video the same way. I'm Dan with Pay Down Debt Solutions. Remember, always align, never alone.